Hello. Here at Save to Invest, we are going to tell you all about bonds and gilts. In this video, we'll focus on the United Kingdom. The City of London is the center of the financial world and will probably remain so because its markets are open for both China and the USA in the same day. It's a huge advantage. The city or square mile offers all investors the greatest confidence. They have, after all, been doing this for many hundreds of years. With that in mind, it should be noted that investors have a wide range of options in the sterling fixed income markets, including UK government-backed gilts and higher-yielding corporate bonds. The demand for income-producing assets has increased due to the popularity of individual savings accounts or a self-invested personal pension that are tax-free among private investors. Moreover, new methods of buying and selling bonds have made them more accessible than ever before. Before we begin, it is really important to understand risk. It is important to note that neither income nor capital is guaranteed, and the value of investments can fluctuate. There is a possibility of receiving less than your initial investment. It is also important to consider that tax rules can change, and the availability of reliefs depends on individual circumstances. Corporate bonds may not be suitable for all investors, therefore seeking advice is recommended if you are unsure. There is a wide range of bond types available, which are investments that represent the debt of a government, company or organization. Essentially, they are loans or IOU promises issued by these entities and purchased by banks, insurance companies, fund managers and private investors. Many investors claim to not understand bonds, but they can be simpler than shares. The key elements of bonds can be broken down as follows. The issuer is the entity borrowing the money. For example, an issuer may borrow 500 million and issue 500 million worth of securities. Typically, these securities are launched at par or 100 pence per pound. The coupon is where the issuer commits to paying a fixed rate of interest, usually annually or semi-annually. This coupon is a predetermined amount. It's important to understand what maturity means. It is a repayment date is set for the borrowed money, known as the maturity or redemption date. The bonds will be repaid at par or 100 pence per pound with rare exceptions. However, if the issuer defaults, investors may lose some or all of their investment and the income generated from the bonds may cease. Bonds are initially sold to investors through an investment bank or broker in what is called the primary market. Additionally, gilt issues are offered directly to the general public. After this initial phase, bonds can be bought and sold between investors and/or market counterparts. Unlike equities, which trade on a centralized stock exchange, bonds are typically traded directly between institutions such as an investment bank and a broker. The global bond market is vast, with a significant number of bonds in circulation. Entities like the European Investment Bank may have hundreds of bonds actively trading at any given time. These bonds can be issued in various currencies and differ in terms of coupon rates, maturity dates, and additional features like embedded put and call options. I will now go through each kind that exists in the UK. Firstly, we will discuss UK government gilts or bonds. These bonds are released by the UK government to fund public expenditures. The prices of these bonds will vary in the market each day, reflecting the potential for changes in interest rates. However, investors who purchase these bonds at or below their face value and keep them until maturity can be confident that they will receive full repayment of both interest and principal. On the other hand, if the bonds are bought at a price above their face value and held until maturity, investors may experience a loss in capital despite the government support. Secondly, there is the conventional gilt. These usually offer a fixed coupon rate, typically paid twice yearly, and have a predetermined maturity date. The range of maturities can vary from a few months to as long as 40 years. Among private investors, the most popular options are usually gilts with maturities between 2 and 10 years. Some gilts may have additional features such as calls that allow the government to repay the debt earlier than scheduled. It is advisable to gather complete information about a specific gilt before making a purchase. The Debt Management Office of the government's website provides prospectuses for gilt issues. Thirdly, the index-linked gilt is interesting. Index-linked gilts, also known as index-linked government bonds, differ from traditional bonds by having their semi-annual coupon payments and principal tied to the UK Retail Prices Index, RPI, rather than fixed amounts. It is important to recognise that there is a delay in using the RPI to determine the coupon and redemption period, but these bonds do provide protection against inflation. Due to their inflation-linking feature, index-linked gilts may exhibit greater price fluctuations over time. Fourthly, there are undated gilts without a specific maturity date, also known as perpetual gilts. These do not have a predetermined date for repayment. It is solely up to the government to decide if and when they will repay these bonds. As a result, the holders of these bonds must rely on market conditions to sell them, making them more susceptible to volatility and risk compared to traditional gilts. One notable example within this category is the UK 3.5% war loan. Fifthly, there is a non-gilt sterling-denominated bonds make up a significant portion of GBP-denominated bonds that are not UK gilts. These bonds can be issued by various types of entities, such as foreign governments, UK banks, and medium-sized companies. Similar to gilts, bond prices will fluctuate based on the market's interest rate expectations. However, the perceived creditworthiness of the issuer will also impact the price and consequently the yield of the bond. If the issuer's credit quality is believed to be worsening, the bond price will decrease. There are other kinds of bonds called retail bonds, permanent interest-bearing shares, floating rate notes, convertible bonds, and subordinate bonds. We won't discuss them here. What are the benefits of choosing bonds? Shares and bonds are two distinct types of investments with differing characteristics. Shareholders have ownership in the company, while bondholders simply provide financial loans to the company. Due to this distinction, the risk or reward profile varies greatly. For bondholders, the primary concern is whether the company has sufficient funds to repay the loan and meet its debt obligations. Even if the company's profits decrease significantly or regular dividends are reduced, as long as the company fulfills its commitments to bondholders, they will continue to receive a fixed interest rate and have their initial investment returned upon maturity. Considering risk and potential returns, bonds typically fall between cash and shares on the investment spectrum. Bonds and gilts provide a sense of security due to the low risk of major governments, including the UK, defaulting on their debts. In theory, government bonds are deemed to be of higher credit quality compared to bank deposits. However, in practice, the government guarantees bank deposits, thereby making them equally secure. Additionally, high-grade multinational government agencies like the World Bank offer a very safe investment option for bondholders. It is important to note that not all bonds are issued by governments. Many are issued by companies and organizations whose ability to repay the debt may be less certain. Nevertheless, even corporate debt is generally considered a less risky investment than owning shares in the company. In the event of bankruptcy, bondholders have a higher priority in claiming the company's assets compared to shareholders. However, if the company fails to meet its obligations to bondholders, their invested capital and income are at risk. When it comes to the return of capital, there is a significant distinction between bonds and equities. To reap gains or losses from equities, one relies completely on the ability to sell the shares back to the market. On the other hand, when an investor purchases a bond, the redemption date and value are predetermined. As long as the issuer is capable of repaying, the investor's dependence on uncertain future market sentiment or liquidity is diminished. Are bonds a dependable source of income for an investor? Indeed, bonds offer a dependable source of income that can be beneficial for investors seeking stability. In comparison to stocks, bonds generally provide higher income. Furthermore, the future income payments from bonds are more predictable, unlike dividends from stocks, which can be reduced or halted during periods of low profitability. This predictability makes bonds an attractive option for investors who want to safeguard their income over a specific time frame. By investing in carefully selected bonds that pay annually, semi-annually, or quarterly, a diversified bond portfolio can generate a reliable monthly income. It is important to note that most bonds pay their interest without withholding taxes. Investors can take advantage of this by holding qualifying bonds within an ISA, which allows for tax-free income. However, it is crucial to remember that tax regulations may change, and the availability of tax reliefs depends on individual circumstances. Additionally, it should be kept in mind that the income from bonds is not guaranteed and relies on the issuer's ability to make payments. To effectively manage a portfolio, it is essential to include a variety of asset classes. These asset classes may include equities, government bonds, index-linked bonds, corporate bonds, and alternative assets, each playing a unique role. One of the most effective strategies for mitigating risk is to diversify a portfolio. By diversifying, investors can reduce their exposure to adverse economic scenarios, such as recessions. In such situations, certain bonds can provide a protective shield against declining share prices. When purchasing a fixed coupon bond, investors secure a set interest rate for a specific duration. If interest rates increase, the bond's income becomes less appealing and its market value declines. Conversely, a decrease in interest rates leads to an increase in the bond's market value. Investors who buy bonds when interest rates are falling enjoy the advantage of both a stable income and the potential appreciation of their investment. It is important for investors to recognize that interest rates are currently at their lowest and are likely to rise in the future. Speculating on price movements is a feature of any investment. Like any other financial instrument, bonds also provide the opportunity to speculate on future price movements. Traders often utilize liquid government bonds to speculate on interest rates, whereas changes in the perceived credit quality of the issuer can cause significant price fluctuations in corporate bonds. Investing in bonds, like any other investment, carries its own set of risks. The value of investments can both rise and fall, and there is a possibility of receiving less money than what was initially invested. One risk that bond investors face is the potential for default. If the issuer is unable to pay back the full or partial amount of the capital and interest payments, it is considered a default. In the equity market, this would be equivalent to a company going bankrupt, ceasing operations, or being forced into administration. Market risk is another factor to consider. The price of bonds can fluctuate on a daily basis depending on the supply and demand in the market, resulting in potential gains or losses. If an investor needs to sell the bond before its maturity to raise funds, there is a risk of experiencing a loss of capital. Certain bonds come with specific features such as calls, which allow the issuer to repay the debt before the scheduled maturity date. This can be unfavorable for the bondholder. Investors should carefully review the bond's prospectus to understand such features and seek advice if unsure about the suitability of the investment. Another category of risks includes event and other operational hazards. This encompasses factors like changes in tax treatment, which can be unfavorable or punitive. It's important to remember that tax rules can change, and any potential tax reliefs depend on individual circumstances. These risks can be mitigated through careful planning and monitoring. Additionally, there are event risks that can impact bond investments. For example, if the issuer becomes the target of a leveraged buyout, where the acquiring company uses debt to purchase the issuer, it increases the risk associated with lending money to the company. Lastly, the risk of inflation should be considered, as it can gradually devalue the asset or portfolio over time. It is strongly recommended that when buying bonds, you use a reliable firm of experts. You can find some in our links below. We hope you are enjoying our content, so please smash the like button and subscribe. It helps us to build this channel.